The numbers appeared quietly in the latest report from the International Monetary Fund, without fanfare or headlines that would shake the financial world. Yet their implications ripple through the foundations of the global economic order. The United States dollar, which has reigned as the undisputed monarch of international reserves for nearly 8 decades, now represents just below 58% of all central bank holdings worldwide. This figure marks the lowest proportion in 3 decades, a threshold that economists have watched with growing unease. Simultaneously, central banks across the globe have embarked on a gold-buying spree unprecedented in modern history, accumulating over 800 tons of the precious metal in a single year. These two phenomena are not coincidental. They represent the visible manifestation of a tectonic shift in how nations perceive value, security, and trust in the international monetary system. To understand the gravity of this moment, we must resist the temptation to see it as merely a statistical fluctuation or a temporary response to geopolitical tensions. The architecture of global finance does not transform casually. When central banks, the most conservative and risk-averse institutions in existence, collectively alter their reserve strategies, they are signaling something profound about their expectations for the future. They are hedging against a scenario that once seemed unthinkable. A world in which the dollar no longer serves as the universal medium of exchange, the ultimate store of value, the anchor of stability. The 58% threshold is not just a number. It represents a psychological boundary, a point at which the network effects that have sustained dollar dominance begin to weaken, where alternatives become not just possible, but practical. History offers us a lens through which to view this transformation, and that lens reveals a pattern both instructive and sobering. The transition of global reserve currency status is not a sudden catastrophe, but a gradual erosion, a slow bleeding of confidence that accelerates only in its final stages. We need look no further than the fate of the British pound sterling to understand this dynamic. In the early 20th century, the pound stood as the unquestioned foundation of international commerce. Backed by the vast resources of the British Empire, the sophistication of London's financial markets, and the credibility of the Bank of England. More than 60% of global trade was denominated in sterling, and the City of London functioned as the beating heart of world finance. British investors had placed enormous sums in every corner of the globe, from railways in Argentina to plantations in Malaysia, creating a web of economic relationships that seemed permanent and unshakable. Yet beneath this facade of strength, structural weaknesses were accumulating. The First World War had transformed Britain from the world's largest creditor nation into a debtor, forcing the government to borrow heavily from the United States to finance the war effort. The pound's gold convertibility, suspended during the conflict, was restored in 1925 at the pre-war parity, a decision driven more by national pride than economic wisdom. Winston Churchill, then Chancellor of the Exchequer, later admitted this choice was perhaps the greatest mistake of his career. The overvalued pound made British exports expensive and uncompetitive, contributing to chronic unemployment and economic stagnation throughout the 1920s. British industry struggled while newer economic powers, particularly the United States and Germany, captured market share with more modern production methods and more favorable exchange rates. The decisive blow came in 1931, during the depths of the Great Depression. A banking crisis that began in Austria spread across Europe, and investors began to doubt whether Britain could maintain the pound's gold convertibility. Capital flight accelerated as foreign holders of sterling rushed to exchange their pounds for gold, draining the Bank of England's reserves at an alarming rate. In September of that year, facing the imminent exhaustion of its gold holdings, Britain abandoned the gold standard. The pound's value plummeted, and with it went the perception of sterling as a safe, stable reserve asset. Countries across the world that had trusted Britain to maintain the value of their reserves found themselves holding devalued currency. The psychological impact was devastating. If Britain, the source of financial innovation and the guardian of economic orthodoxy, could not maintain its commitments, what guarantee existed anywhere in the global system? The pound did not disappear from international use immediately. It remained important, particularly within the sterling area, a group of countries that continued to peg their currencies to the pound and hold their reserves in London. But its dominance was broken. As the 1930s progressed, countries increasingly settled trade in other currencies or through bilateral agreements that bypassed the traditional reserve system entirely. The United States dollar, backed by the world's largest economy and substantial gold reserves, began to assume a larger role in international transactions. The Second World War accelerated this transition dramatically. Britain, once again forced to borrow massively to finance its war effort, became deeply indebted to the United States under the Lend-Lease program. By the war's end in 1945, Britain was effectively bankrupt, its economy exhausted, its empire beginning to crumble. The Bretton Woods Conference of 1944 officially recognized the new reality, establishing a system in which the dollar, not the pound, would serve as the primary reserve currency convertible to gold at $35 per ounce, with other currencies pegged to the dollar. The lesson from this historical transition is clear. Reserve currency status is not lost in a single dramatic event, but through a process of accumulating doubts, policy mistakes, and the gradual shift of economic power. The period from 1931, when the pound left gold, to 1945, when the dollar-based system was formalized, encompassed 14 years of declining confidence. For much of that time, observers might have argued that sterling remained important, that its role was secure within certain spheres, that reports of its demise were exaggerated. They would have been technically correct, yet fundamentally wrong about the direction of travel. The momentum, once established, proved irreversible. Today, we witness similar dynamics unfolding, though the actors and mechanisms differ. The catalyst for the current de-dollarization trend is not a depression or a world war, but rather the deliberate policy choices of the United States government and the strategic responses of other major powers. The story begins with the recognition by countries like China and Russia that dollar dominance grants the United States enormous geopolitical leverage. When a nation holds its reserves primarily in dollars, it must maintain those reserves in the form of dollar-denominated assets, predominantly United States Treasury securities. This creates a structural dependency. Countries export goods to America, receive dollars in payment, and then lend those dollars back to the United States government by purchasing Treasury bonds. The United States, in turn, can run persistent trade deficits and budget deficits because foreign central banks continuously recycle their dollar earnings back into American debt. This system has enabled the United States to maintain living standards beyond what its productivity alone would support, financing consumption through foreign savings. It has also created a weapon. The dollar's role as the medium of international exchange means that most global transactions must pass through dollar clearing systems controlled by American banks and ultimately overseen by American regulatory authorities. This gives the United States the power to exclude entities from the global financial system through sanctions. In the aftermath of Russia's annexation of Crimea in 2014, and more dramatically following the invasion of Ukraine in 2022, the United States and its allies deployed this weapon with unprecedented scope. Russian banks were cut off from the SWIFT messaging system, Russian central bank reserves held in dollars, and euros were frozen, and Russian entities found themselves unable to conduct basic international commerce. The effect on Russia was severe, but the effect on other nations' perceptions was perhaps more significant. China, watching these events unfold, understood that its own vast holdings of United States Treasury securities, exceeding $1 trillion, could theoretically be subject to similar treatment in the event of a serious conflict, perhaps over Taiwan. Smaller nations recognized that their sovereignty was constrained by their dependence on a monetary system controlled by a single foreign power. The fragility of the arrangement became apparent. Trust, the foundation of any reserve currency, began to erode not because of American economic weakness, but because of the perception that dollar-based reserves could be confiscated or frozen for geopolitical reasons. The response has been systematic and deliberate. China, the world's second-largest economy and largest trading nation, has reduced its holdings of United States Treasury securities from a peak of nearly $1.3 trillion to below $800 billion over the past decade. This divestment has been gradual, careful not to disrupt markets or trigger a crisis. but the direction is unmistakable. Simultaneously, the People's Bank of China has dramatically increased its gold reserves, though the true extent of these holdings remains opaque, given China's history of announcing reserve increases only retrospectively. Other central banks have followed suit. Russia, before its foreign reserves were frozen, had already shifted substantially out of dollars and into gold and euros. India, Turkey, and numerous emerging market central banks have joined the gold-buying surge, driven by a desire to hold reserves that cannot be sanctioned, devalued by another country's monetary policy, or subjected to political conditions. The BRICS nations, comprising Brazil, Russia, India, China, and South Africa, along with newly admitted members including Saudi Arabia and the United Arab Emirates, have discussed creating alternative payment systems and potentially a common currency for trade settlement. While a unified BRICS currency remains more aspiration than reality, the group has made concrete progress in facilitating trade in national currencies, bypassing the dollar. China and Russia now settle much of their bilateral trade in yuan and rubles. Saudi Arabia, long the cornerstone of the petrodollar system, has begun accepting yuan for oil sales to China, a development that would have been unthinkable a decade ago. The petrodollar, the informal arrangement by which oil-exporting nations sold their product exclusively in dollars and recycled those dollars into American assets, emerged in the 1970s as a pillar of dollar dominance. Its erosion represents a fundamental shift in global monetary architecture. These developments create a self-reinforcing dynamic. As more trade occurs in currencies other than the dollar, the need for countries to hold large dollar reserves diminishes. As dollar reserves decline as a share of global holdings, the liquidity and network effects that make the dollar useful for international transactions weaken. Alternative systems, once too small and illiquid to be practical, reach a scale where they become viable competitors. The 58% threshold matters because it represents the point at which the dollar transitions from being the overwhelming default choice to being merely the largest option among several. In network economics, such transitions can accelerate rapidly once a tipping point is reached. The mechanics of how this process unfolds deserve careful examination. When a central bank decides to reduce its dollar reserves, it faces a practical challenge. What should replace those dollars? The alternatives each have limitations. The euro, the second most widely held reserve currency, represents about 20% of global reserves. But the eurozone's political fragmentation and structural economic problems make it an imperfect substitute. The Japanese yen and British pound play minor roles, accounting for single-digit percentages of reserves. The Chinese yuan, despite China's economic heft, represents only about 3% of global reserves, constrained by China's capital controls and the incomplete convertibility of its currency. This leaves gold, the ancient form of money that belongs to no nation and cannot be printed or devalued by any government. Gold possesses unique properties as a reserve asset. Unlike currencies, it cannot default. Unlike bonds, it pays no interest, but it also cannot lose value through the insolvency of an issuer. Unlike digital entries in a banking system, physical gold held in a central bank's own vaults is immune to sanctions or freezing. These characteristics become particularly attractive in an era of geopolitical tension and economic uncertainty. The sustained central bank gold purchases of recent years reflect a collective judgment that the geopolitical risk of holding reserves in assets subject to another nation's control exceeds the opportunity cost of holding a non-yielding asset like gold. This calculation represents a profound shift in how sovereign nations think about the security of their wealth. The implications of this transition for the United States economy are multifaceted and severe. American living standards have been subsidized for decades by the dollar's reserve status through several mechanisms. First, the constant foreign demand for dollars and dollar-denominated assets has kept the dollar's value artificially high relative to what America's trade balance would otherwise support. This overvaluation makes imports cheaper for American consumers, allowing the purchase of foreign goods at lower prices than would otherwise be possible. The average American household benefits from inexpensive electronics, clothing, and consumer goods produced abroad, a direct result of the strong dollar. Second, Foreign central banks' purchases of United States Treasury securities help finance the federal government's budget deficits at lower interest rates than a purely domestic market would demand. This has allowed the government to spend beyond its tax revenues with less fiscal constraint than countries without reserve currencies face. Third, American financial institutions benefit from the central role of the dollar in global finance. The need for international banks to hold dollar deposits, for companies to maintain dollar accounts, and for financial institutions worldwide to access dollar funding creates demand for the services of American banks. Wall Street's position as a global financial center derives partly from its privileged position in the dollar system. Fourth, the United States can pay for imports in its own currency, never facing the constraint that limits other nations. If South Korea or Brazil runs a trade deficit, it must pay for imports in a foreign currency, requiring it to earn that currency through exports or attract it through foreign investment. America simply prints more dollars or issues more debt denominated in dollars, which foreigners must accept if they wish to trade with American buyers. As the dollar's reserve status erodes, these advantages diminish. A weaker dollar makes imports more expensive, directly reducing American purchasing power and living standards. Higher interest rates on Treasury securities increase the cost of servicing the national debt, now exceeding $34 trillion. This crowds out other government spending or requires higher taxes. The federal government faces harder budget constraints, forced to choose between competing priorities rather than financing all demands through borrowing. American financial institutions lose business to foreign competitors as international transactions increasingly occur in other currencies or through alternative systems. Most fundamentally, the United States can no longer export its inflation to the rest of the world by printing dollars that foreigners must absorb. When the Federal Reserve expanded the money supply dramatically during the financial crisis and the pandemic, much of that monetary expansion flowed overseas as foreign central banks accumulated dollar reserves. In a world where dollars are less desired, monetary expansion stays domestic, manifesting as higher consumer price inflation within the United States. The defenders of the dollar often point to the lack of viable alternatives, arguing that no other currency possesses the depth, liquidity, and stability of the dollar-based system. This argument has merit, but misses the crucial point that reserve currency transitions do not require a single replacement. The future international monetary system may be multipolar, with several regional currencies serving as reserves within their spheres of influence and gold, or potentially digital currencies playing a role as neutral settlement assets. The euro serves European trade, the yuan serves Asian trade, and various bilateral arrangements fill the gaps. Such a fragmented system would be less efficient than the dollar-based order, with higher transaction costs and more currency risk. But efficiency is not the only consideration. Nations are proving willing to accept lower efficiency in exchange for greater autonomy and reduced vulnerability to American policy decisions. The path forward is not predetermined, and the pace of de-dollarization depends on choices yet to be made. If the United States reduces its use of financial sanctions as a geopolitical tool, some nations may reconsider their rush away from the dollar. If American fiscal policy becomes more sustainable, reducing the growth of debt and the risk of eventual monetary financing, confidence in the dollar could stabilize. If alternative systems prove cumbersome and unreliable, countries may return to the devil they know. Conversely, further geopolitical confrontations, additional weaponization of dollar access, or a domestic fiscal crisis could accelerate the transition dramatically. The trajectory is not linear, but depends on the interaction of economic fundamentals and political decisions. What seems increasingly clear is that the unipolar moment in monetary affairs, like the unipolar moment in geopolitics, is passing. The world is fragmenting into competing systems and rival visions of economic order. The dollar will remain important, perhaps even dominant in certain spheres, for years or decades to come. But the trajectory resembles that of the British pound a century ago, still significant, still widely used, but no longer the unquestioned foundation of the global system, no longer the asset that all nations must hold, regardless of other considerations. The 58% threshold marks not the end of dollar dominance, but the acceleration of its decline, the point at which momentum shifts decisively. For those seeking to understand the implications for their own economic futures, the lesson is not to panic or to make dramatic changes based on short-term developments. The transition from one reserve currency regime to another unfolds over years and decades, not months. But the direction of travel matters, in which the consequences of fiscal profligacy cannot be exported abroad, in which living standards depend more directly on productive capacity rather than monetary privilege. This adjustment will be painful and will require difficult political choices that have been deferred for a generation. The historical parallel to the pound's decline suggests that the process, once begun, proves difficult to reverse. Britain never regained its former monetary preeminence, even as its economy eventually stabilized and even prospered in the post-war decades. The structural position was lost, and with it went certain advantages that had accrued during the period of dominance. The United States faces a similar prospect. The task ahead is not to prevent de-dollarization, which appears to have acquired its own momentum, but to manage the transition in a way that minimizes disruption and preserves as much advantage as possible in the emerging multipolar monetary order. This will require wisdom, restraint, and a willingness to adapt to a world in which American power, while still substantial, is no longer hegemonic in the monetary sphere as it has been for 80 years. The numbers that appeared quietly in that IMF report are telling us something important about the future. The question is whether we are prepared to listen and to adjust our expectations and policies accordingly, or whether we will cling to assumptions formed in a different era until reality forces a more abrupt and painful reckoning.